If you approve segment-level financial reporting for a multi-geography business, Archer-Daniels-Midland's $40 million SEC penalty shows how corporate fraud at the segment level can persist across multiple quarters before enforcement. The SEC enforcement action, filed January 16, 2026, describes this as accounting fraud under federal securities law, not technical violations, not control deficiencies, but fraud-level manipulation of segment reporting that resulted in materially inaccurate public filings. The surprising part is that this wasn't an external breach. The SEC's description centers on internal booking and review activity that allowed misclassification to persist across reporting periods. This case reveals a pattern where documented accounting policies existed, but the SEC found that controls were not designed or operated effectively to prevent segment-level misclassification. Archer-Daniels-Midland is a U.S.-listed agribusiness operating across multiple geographies with segment-level P&L reporting requirements under SEC disclosure rules. The SEC enforcement centers on ADM's Mexico ethanol trading unit, where the agency alleged that finance personnel manipulated segment reporting over multiple quarters from 2018 to 2019. In multi-geography corporations, segment reporting breaks down company performance by business unit, product line, or geography to give investors visibility into which parts of the business drive earnings. Each segment has its own P&L center, with finance teams responsible for classifying revenues, costs, gains, and losses according to accounting policies and segment definitions. ADM's Mexico ethanol trading operated as a distinct segment with internal performance targets and quarterly reporting obligations that fed into consolidated company disclosures. Finance executives typically operate on the assumption that multi-layer review structures, segment controllers, group consolidation teams, external auditors, audit committees, create detection mechanisms for systematic manipulation. The assumption is that one person or team cannot systematically move material amounts between segments without triggering questions somewhere in the review chain. Here's the part most teams miss. According to the SEC, the Mexico ethanol unit had internal targets for segment performance, and the misclassification served to inflate that segment's results to meet those targets. The SEC description indicates that classification decisions became aligned with performance objectives rather than accounting accuracy. The misconduct period spanned 2018 to 2019 over multiple quarters, with the SEC settlement announced January 16, 2026, a gap of 6 to 7 years between fraud and enforcement resolution. The delay doesn't weaken the precedent. It signals that segment-level manipulation remains on SEC radar even when discovered years after occurrence. This wasn't a one-quarter accounting error or immaterial rounding. The SEC described systematic classification manipulation over multiple periods that inflated segment performance while the misstatement persisted across reporting cycles. In commodity trading businesses like ethanol, each transaction generates either a gain, sold for more than purchase cost, or a loss, sold for less, or market value declined. Finance teams classify these gains and losses into segment buckets. If the trade occurred in Mexico ethanol operations, it gets classified in the Mexico segment. If it's corporate-level activity, it goes to corporate. The classification decision matters because investors evaluate segment profitability separately. A strong Mexico segment result signals operational success. Weak results trigger questions about market position or management execution. This pattern keeps showing up. The SEC alleged that ADM misrepresented its ethanol trading performance by manipulating the timing and classification of gains and losses in its Mexico business. Specifically, losses were shifted into a corporate segment while gains were left in the Mexico reporting unit, inflating that segment's results to meet internal targets. This is not about changing the total company profit. The losses still exist. They're just reclassified to a different bucket, so the Mexico unit appears more profitable than it actually was. Finance and accounting personnel in the Mexico unit and related oversight chain were responsible for booking and reviewing the entries that moved losses out of the business. This wasn't external fraud or unauthorized access. The SEC's description points to personnel with standard booking authority making classification decisions that favored one segment over another. The vulnerability appears when classification discretion exists without an effective challenge mechanism operating at the transaction level. The misconduct occurred over multiple quarters, around 2018 to 2019, affecting ADM's segment reporting and public disclosures repeatedly across financial reporting periods. One quarter could be a mistake. Multiple quarters establishes a pattern, and the pattern persisted through quarterly close processes, management representation letters, and SEC filing certifications. The failure mode is that the misclassification didn't trigger escalation or correction across the typical review gates. This is where governance breaks down. The fraudulent adjustments resulted in materially inaccurate figures in ADM's periodic SEC filings, including overstated operating profit in the affected segment. Materially inaccurate is an SEC legal designation. It means the misstatement is significant enough that investors would consider it important in making investment decisions. The SEC found this wasn't immaterial classification differences or one-time errors. It was fraud-level manipulation where finance personnel with booking authority systematically moved losses to make one segment look stronger than it was, and the pattern persisted across multiple reporting periods. This control breakdown follows a pattern we've analyzed in prior Scam Beast episodes. When fraud occurs inside the control structure rather than bypassing it externally, the assumption that we have controls can become the vulnerability rather than the defense. Most finance executives operate on the belief that control existence equals control effectiveness, that documented policies, ERP workflows, consolidation reviews, external audits, and SOX compliance collectively prevent systematic manipulation. The SEC's finding directly challenges this equivalence. ADM's internal accounting controls were not designed or operated effectively enough to prevent or detect the misclassification. The SEC's finding is blunt. The controls were not effective in design or operation. In plain English, the control system did not reliably stop or surface segment misclassification before it flowed into public reporting. The pattern persisted across multiple reporting periods without being surfaced in time to prevent materially inaccurate filings. Group consolidation teams typically verify that segment totals reconcile to corporate totals. They ensure nothing is double-counted or omitted. But reconciliation doesn't necessarily re-evaluate whether individual transactions were classified in the right segment. Here's the part most teams miss. If the Mexico finance team reclassifies a loss to corporate and the corporate team accepts it, consolidation sees balanced entries and doesn't flag the issue unless someone questions the underlying business rationale. The case demonstrates a governance vulnerability when regional finance personnel make classification decisions aligned with performance targets rather than accounting accuracy, and those decisions don't trigger escalation flags. Governance-level oversight operates too far from the transaction level to detect the pattern. This is where executive deception becomes structurally embedded, not through individual lies, but through governance structures that can't see transaction-level manipulation. Audit committees review financial reporting, significant accounting judgments, and management override risks, but segment classification decisions typically don't escalate to board level unless there's a specific concern raised by management, internal audit, or external auditors. External auditors test controls and sample transactions, but they can't review every journal entry. They rely on management representations that classifications follow policy and that exceptions are disclosed. The distinguishing feature appears to be whether classifications were challenged beyond reconciliation, whether someone with authority, independent of performance pressure, verified that business justifications reflected economic substance. The lesson isn't a to-do list. It's recognizing that segment reporting fraud exploits the gap between transaction-level execution, where classification happens, and governance-level oversight, where materiality and disclosure are evaluated. Controls designed to catch external fraud or calculation errors don't necessarily catch internal manipulation, where personnel with authority make classification decisions that technically comply with entry mechanics but violate substance because the business justification serves performance targets. The SEC enforcement shows that having segment reporting policies, consolidation processes, and governance oversight doesn't guarantee detection when the manipulation happens at the classification decision level, where finance personnel have discretion and performance pressure creates incentive. The SEC described the conduct as accounting fraud that violated the books and records and internal controls provisions of the federal securities laws. This designation matters. The SEC could have framed this as control deficiencies or disclosure violations, but calling it fraud signals deliberate manipulation rather than negligent oversight. The fraud label creates reputational damage, shareholder litigation risk, and potential criminal referral considerations that technical violations don't carry. This is the enforcement mechanism underneath the story. Under Section 13(b)(2)(a) of the Securities Exchange Act, public companies must keep books and records that accurately reflect transactions in reasonable detail. When ADM's segment classifications moved losses to corporate while gains stayed in Mexico, the books reflected entries but not the accurate economic substance. The records showed transactions occurred, but misrepresented which business unit generated the results. Section 13(b)(2)(b) requires companies to maintain internal accounting controls sufficient to provide reasonable assurances that transactions are recorded as necessary to permit preparation of financial statements in conformity with GAAP. The SEC finding that internal accounting controls were not designed or operated effectively is a direct 13(b)(2)(b) violation. The controls didn't prevent systematic misclassification that distorted segment reporting for multiple quarters. ADM consented to the settlement without admitting or denying the SEC's findings, but agreed to cease and desist from further violations of the cited provisions. The $40 million penalty reflects the materiality of the misstatements, the multi-quarter persistence, and the enforcement signal the SEC is sending about segment reporting integrity. The enforcement action doesn't name individual defendants, CEO, CFO, segment controllers, but the SEC's description makes clear that finance and accounting personnel were responsible for the entries, creating professional liability shadow, even without individual charges. The enforcement creates a precedent. Segment-level manipulation by finance teams creates corporate liability, even without executive-level individual charges, because control design and operation are senior management responsibilities under securities law. CFOs and controllers hold ultimate responsibility for financial reporting accuracy and internal control effectiveness. The SEC enforcement creates precedent that segment misclassification failures escalate to executive-level accountability. Segment finance leads have direct authority over classification decisions and performance reporting, Internal target pressure combined with classification discretion creates the vulnerability the SEC enforcement highlights. Audit committees carry oversight responsibility for financial reporting integrity and management override risks. Multi-quarter segment manipulation that persists without detection raises questions about committee effectiveness and director fiduciary duties. Internal audit functions are responsible for testing control, effectiveness, and detecting management override. If segment misclassification patterns persist undetected, it exposes internal audit scope and risk assessment gaps. This isn't specific to agribusiness or commodity trading. Any company with segment reporting has the same structure: regional units with P&L responsibility, finance teams with classification authority, consolidation processes, and governance oversight. Tech companies with product line segments, manufacturers with geographic divisions, service firms with practice area reporting, and businesses with project-level P&L all face identical vulnerability patterns, where classification discretion meets performance pressure. This pattern keeps showing up. Project-based businesses follow the same pattern. Performance is reported by unit, whether that's a project, product line, or geographic segment, and rolled up into consolidated results. The vulnerability appears when classification and allocation decisions affect how performance is presented at the unit level, and those decisions operate below the threshold, where governance-level review provides substantive challenge. The enforcement action exposes a recurring pattern. Companies have controlled documentation, policies, procedures, SOX compliance, but the SEC found those controls were not designed or operated effectively to prevent misclassification. The distinguishing feature appears to be whether segment classifications were subject to substantive challenge beyond reconciliation verification. The blind spot that allowed ADM's segment misclassification to persist for multiple quarters exists wherever segment-level personnel have classification, discretion under performance pressure, and the review mechanisms operate primarily at the reconciliation level rather than challenging business substance. Archer-Daniels-Midland's $40 million SEC settlement demonstrates how segment-level corporate fraud through classification manipulation can persist for multiple quarters when finance personnel with booking authority systematically reclassify transactions and the control structure, as described by the SEC, did not prevent or detect the misclassification before it contributed to materially inaccurate periodic SEC filings. The case illustrates a professional exposure pattern. Documented accounting policies and SOX-compliant controls existed, but the SEC found they were not designed or operated effectively to prevent fraud when classification decisions made at the transaction level served performance targets rather than accounting accuracy. The SEC's fraud designation and $40 million penalty signal regulatory scrutiny of whether controls actually prevented or detected segment misclassification, not just whether control documentation existed. I analyze corporate fraud patterns so you don't have to. Follow Scam Beast if you're accountable for money, risk, or approvals. Full sources and documentation are in the description. If you oversee segment reporting, this case is a clean example of how performance pressure combined with classification discretion can become a disclosure risk when it persists across reporting periods. This analysis is based on the SEC enforcement order against Archer-Daniels-Midland, as reported by ICLG on January 16, 2026, supplemented by law firm analysis from Foley and Lardner, and governance commentary from NYU Compliance and Enforcement. In future episodes, we'll continue analyzing how corporate fraud exploits control design gaps, where governance operates too far from transaction-level execution to detect manipulation. The pattern applies beyond segment reporting to any area where personnel with authority make judgment calls under performance pressure. The ADM enforcement signals that reconciliation and heavy review structures may fail to surface systematic segment misclassification when the classification rationale isn't challenged at the same level where the entries are made.